am so excited to welcome today's webinar host, Jonathan Hoy. Jonathan Hoy is a financial executive and CPA with over 20 years of experience in healthcare and finance, and he has a super extensive knowledge of practice operations. We are so pleased to have him on the leadership team here at Team GPS. But formerly, Jonathan was the Associate Vice President of Finance for Duke University Health System and the CFO of Duke Regional Hospital, as well as holding a number of other really wonderful positions here in the Triangle. In 2016, Jonathan was awarded the CFO of the Year Award by the Triangle Business Journal, and today he drives financial innovation and growth at Go Media and GPS. We affectionately call Jonathan our Chief Fun Officer, in addition to being our resident expert on all things finance and business operations. So without further ado, I am so excited to welcome Jonathan Hoy to today's webinar.
Thank you, Heather, for that great introduction. And yes, a Chief Fund Officer is something I've been referred to in the past, but it's 2 days before our taxes are due, and so I don't know how much fun that specific topic will be, but we'll try to make it as fun as possible today. So I hope you guys enjoy today's lesson. So today, welcome to Gladiator Practice Solutions, the Stop Leaving Money on the Table webinar. This is going to be about tax planning and share utilization, really about how do you increase your cash flow and potentially have more capacity to be able to do and to have more growth. So, disclaimer to start with, I am a certified public accountant, but this course is for educational purposes only. Every practice is different and everybody's strategies are different. So the things that we discuss, please don't take those as personal advice. This is not a replacement for your individual guidance from your personalized professional. But our goal today is just kind of think about what things to look for, what opportunities are there that exist, and then what questions should you be asking your financial advisor. So what we're going to cover today. So, understand the tax law changes. With the big, beautiful bill, a lot of things changed in 2025. And we're going to go over a few things that I commonly get asked questions about from dental practice owners and physicians. We're also going to look at and analyze the difference between Invisalign versus braces for orthodontic practices, and then also the opportunities that Invisalign gives for the general practitioner. We will then show kind of a share analysis to see what a slight impact in the change of your percentage of share of chair for Invisalign, what that can do from a capacity and financial standpoint from the bottom line. And then we'll look at some of the tools and go through in a little bit more detail. But at the end of the day, what we want to be able to do is help you make more and keep more of your money. So tax planning. Again, everybody's favorite topic. One of the things that we want to be able to do in this webinar is to give you the opportunity to understand where you are relative to other people on the webinar, and then just give me a sense of what we're looking at in the group that we have. So we're going to have an interactive poll, and there's going to be several of these throughout the course. And so the first one is, when do you typically think about your taxes? So is that during the year, at the end of the year, at filing, or when you write your check? So please go ahead. You should have popped up on your screen to go ahead and answer that question. I see we've got some responses coming in. So some are during the year, some are at filing, and some are at year end. Okay, those are all great answers and responses. It looks like we've got an equal number of each. I'm glad to see that no one actually checked the box when I write the check, because that's absolutely the last moment for you to be able to do anything. Let's talk about what are your taxes based on? They're based on the decisions that you make. And so as you make decisions throughout the year, that changes your facts and your circumstances. And so the first thing is your decisions. What you're doing, when you're doing it, the structure that you have created. Are you an LLC? Are you an S Corp? Are you a C Corp? Are you just a Schedule C sole proprietor or a W-2? So understanding how the structure of your income is helps you be able to plan. And then the timing of the decisions that you make will definitely have an impact, making sure that you get things done. But prior to the end of the year, you get the right things placed into service. And then you're ultimately, all of those facts and circumstances will end up with where you end up on your taxes. I always say, if you want to change your tax, you've got to change your facts. And so if you don't change your facts and circumstances, then your taxes are just going to be something that you're filing and you're not planning those things out. So what things drive your income? Well, obviously how much you earn, and that could be your W-2 employment income. It could be the profit and loss from your business, then how you're structured. So a C Corp pays its own taxes, whereas an S Corp or an LLC, those flow through to your individual income taxes. Then when things happen, again, making sure things happen at the right time of the year to be able to be factored in for current year's investments. What are you investing in? Are you investing in real estate? Are you investing in stocks? Are you investing in oil? I feel like that's probably a pretty good investment right now with the current state of things. And so again, highly recommend that you look at all types of investments, but that factors in obviously into your income taxes. And then ultimately, what are you able to deduct off of your taxes to be able to minimize that tax liability? So the key tax strategies that we're going to talk about in this session today is timing of equipment purchases. So your equipment, technology, and kind of the cash flow impact of that. We're also going to look at vehicle and asset planning, passive versus active real estate, the qualified business income deduction, or QBI. You'll hear me say QBI, but that's the qualified business income deduction, which is up to 20% of your income from your business. Then we'll talk a little bit about strategic deductions and planning tools. And then finally, we have just released the 2024 IRS data. So we'll look at some of the statistics of what the IRS looked at in terms of audit risk and what results we have there. So again, we've got another poll. So how are you currently timing your major equipment purchases? Is this based off of your clinical need only? Based off of cash availability? Is it coordinated with your tax planning, or do you really just not have a clear strategy? So far, there's a lot of no clear strategy. So based on cash availability, also an answer. Again, no clear strategy. Okay, well, hopefully today we'll help you with a little bit of some things to think about, particularly as we're talking long-term capital planning, but also just the immediate cash flow needs. So first of all, when you buy a piece of equipment, the first question you need to ask, it isn't about your tax planning or anything else. Do you need it? And so if you don't need it, then you probably don't need to buy it. But the other questions you have to ask is, if you buy it, does it improve my production or my productivity? Will it generate a return on investment? And do I actually have the capacity to be able to use it? All of those play into the decision on whether or not you should buy it. And then the timing of that purchase can have significant impacts on your taxes. So don't make a purchase just based off of taxes. It needs to be based off of the need of your practice. And so we're going to walk through a simple example of a purchase of a scanner. And so we're going to use $50,000 for the scanner. It's a nice round number and easy to be able to. I think right now the current retail price for an iTero, which is what we're talking about here, is around $56,000. So this is a fairly straightforward example, and this is not in any way a GPS sales pitch, but I can tell you, if you are in the market for a scanner, please give Emily Abacassis or myself a call, because we did just receive some into the warehouse, and I can say we are always ready to make a deal on those. So that being said, let's walk through this example. So we're going to say it's a $50,000 scanner. So now, what do you get at purchase? You have a $50,000 asset. So how are you going to pay for it? Well, we're going to finance it over 3 years. And so with that, the cash flow will be spread out. But The IRS limits our deduction on equipment based off of depreciation and useful life. And so, depreciation is basically the systematic and rational allocation of an asset over its life. And so with that, there are certain timeframes and requirements. And the cash is usually upfront or financed, and you get the benefit over time. But one of the things that with the Big Beautiful Bill previously existed was bonus depreciation, but it phased out. And in 2025, it actually was made permanent. So what is bonus depreciation, and how does that impact your timing of your deductions on your equipment? So now with bonus depreciation, there are certain assets that qualify for you to be able to take 100% of that expense in the first year that the asset is placed into service. This becomes huge. Now, and I'll walk through our example of the scanner, but you're paying for it over 3. Previously, you were deducting it over 5, and now with the new regulations, you can deduct all of that in year 1. And so we'll talk about the impact of that. So what qualifies for that? It's equipment, technology. Some certain vehicles qualify, and we have a section on that. It's now permanent, so where in the past you had to worry about it phasing out, now you know and can plan your capital purchases over time and know that this will be there in the future. What's required to be able to count the asset and do a bonus depreciation? So it must be used at least 50% of the time in your trader business. And it must be placed into service in the year that you're taking the deduction. And placed into service does not mean I've purchased it, I've ordered it. It actually has to be in service for your business, and it has to be depreciable property. And it needs to be new to you. It doesn't have to be a brand new piece of equipment, a brand new vehicle, a brand new scanner, anything. As long as it's new to you, it's eligible for a bonus depreciation. And so a little bit more detail in the difference between standard and bonus. I think it's again, spread out over time under standard. And so what you would have seen in the past, let's say you're a 37% tax bracket individual, you would have seen a $3,700 benefit for 5 years on that scanner. Now you take the whole $50,000 and you get the entire $18,500 benefit on your taxes. And so how that looks. And so previously, again, $10,000 deduction for 5 years. You had payments for the financing for 3. And so you had a mismatch of your outflows and your deductions. Now with bonus depreciation, you take it all in year 1. So in the first year, you only have $16,000 out of your pocket, but now you have a $50,000 deduction. And as you're planning your purchases, understanding what this year's tax liability is versus next year, and planning your purchase in accordance with when you think you may have spikes in income now is a little bit more flexible under the new rules. We've talked a little bit about it, but again, the types of equipment that qualify: your CT scanners, your intraoral scanners, chairs, delivery system. Operational items also count. So sterilization equipment, computers, office equipment. Pretty much anything that's used in your trader business that meets the criteria, including vehicles. And so vehicles are a little bit of a special animal, and I'm just curious. On the poll here, do you currently use a vehicle for legitimate business purposes in your practice? Yes. Occasionally. No. Not sure what qualifies. Occasionally. And not sure what qualifies. Again, not sure what qualifies again. Okay. All right. So let's talk a little bit about that. So your vehicle strategy is very similar to your equipment. It must be used in your trader business at least 50% of the time. And you have to have documentation that flows with mileage and usage, and timing of purchase. But one of the things that is key for a vehicle purchase that eliminates some of the limitations is actually the weight threshold. And so for vehicles that weigh over 6,000 pounds, you eliminate some of the limitations on it. So examples of those: Range Rovers, G-Wagons, Tahoes. Larger vehicles typically weigh about 6,000 pounds. They allow you to, bypass some of the limitations on what you're able to do, and particularly the bonus depreciation side of things. And so when we look at what the rules are, it's used for 50% of your business. Now, what does that mean? You could wrap your vehicle or have something on your vehicle that is constantly advertising your business. It could be on the back or the side. It doesn't have to be the entire thing. You could be using it to move from clinic to clinic. You could be using it for events. There's a wide variety of things. The thing I would caution you around, and that could be a little bit of an audit risk, is if you claim that you use a vehicle 100% of the time in your business. And so most of the time, 75 to 90% is usually justifiable when you start to look at things. It has to be placed into service in the year. Again, the 6,000 pound requirement makes the limitations kind of go away and allows you to be able to do it. Mileage tracking is key, but I think there are other ways that you can talk with your tax professional around how you can consider something being used in the trader business. Again, a lot of people are using their vehicles and having their logo, something wrapped on it to be able to have it as a constant marketing presence. Now we want to switch gears a little bit from the purchase of assets and vehicles to talk a little bit more about real estate. And so, were you aware that some rental losses may offset ordinary income depending on the structure? So a lot of times, as people are answering questions, a lot of times people think of passive versus non-passive active income, and real estate typically is a passive activity. Now, again, I would say that based off the last response, I've got a good feeling of how we're going to answer this one. Do you currently use real estate as part of your tax strategy? Yes, somewhat, no, but you're considering it. Where the real opportunity lies on offsetting ordinary income is in your short-term rental strategy. And so what that means is in a short-term rental, those are rentals that are less than 7-day rentals. It's basically your vacation home type of thing. So let's take one more poll on real estate before we dive into that. How are you currently using real estate as part of your overall investment strategy? I know there was a few somewhats. So is it commercial real estate, long-term rental property, short-term rentals, or multi-strategies, a combination, or just not using it currently as an investing vehicle? Not using it. So again, let's dive into that a little bit, particularly on the short-term rental side of things. So short-term rentals, again, are less than 7-day average stay on a rental. Those are allowed to go against your ordinary income. I said again, against your ordinary income. So if you've invested in real estate, you have passive losses that typically you're not eligible to be able to deduct against your W-2 income. That's not the case with short-term rentals. So if you have a vacation home that you also have it where you rent it out on occasion, as long as you average less than 7 days, then that can qualify that as a short-term rental. And it makes it no longer automatically a passive activity. So things to make sure that though, to understand to be able to qualify for non-passive is, there is a material participation rule associated with short-term rentals, but it just means you have to do more than anybody else on that property. And if you do more than 100 hours a year, you basically qualify. That's 2 hours a week of working on your property. You could update an ad, you could be answering a phone call, or you could just be out there working on your house. So again, the owner involvement is key and needs to be documented, but it offsets ordinary income, which it can be extremely advantageous in your tax planning. We've already gone through this, so traditional rentals, passive, short-term. I think the key on real estate in general, in terms of how you accelerate your deductions, goes to in the depreciation side and the cost segregation analysis. I'm going to talk about that in just second. But with cost segregation, it also allows you to use, again, the recurring theme here today, bonus depreciation, be able to get that expense moved forward so that you're able to take that sooner rather than later. So with that being said, cost segregation. When you purchase a home, a house, a commercial, or anything, but in this particular case, a short-term rental, there again are specific IRS requirements around the useful life and depreciation. And if you don't do a cost segregation analysis, it's pretty much everything gets a 27.5 year useful life. So everything gets divided by 27.5, and that's your deduction each year. But you have other things inside of that house, and it's what's inside that you actually can count and take advantage of. And so interior components like HVAC systems or upgrades or things that you've done to improve the property, those have different lives, and those actually become eligible for bonus depreciation. So if you look at without cost segregation, it's pretty much the same deduction throughout the entirety of ownership. But you separate out those things that are not the structure of the home, and with bonus depreciation in the year that you put the house into service, you actually can see a huge benefit. So again, it's a timing and planning tool for you to be able to manage your tax liability. One other thing to talk about from a real estate standpoint, and this is not investment in real estate, but this is your own home. Question for you. Are you currently benefiting from the Augusta rule? Yes, partially, no, not sure. What we'll do is go a little bit about what the Augusta rule is. It is actually fairly simple, but it is definitely a target income strategy. So how it works, you can rent your personal residence to your home. As long as you do that for less than 14 days in the year, that rental is completely tax-free to you as the homeowner. Now, it must be done at a fair market value rate. So you need to do some comparables on event space or meeting spaces. And you do need to document that you actually had an agenda, who was at the meetings, just in case you ever need that documentation. But how that's treated. So, let's say, you're renting your house out for a strategic planning event for the leadership. And then, if everybody's just coming to your house for that meeting, well, you as the business get to take a tax deduction for that expense, pay yourself for that rental, and then there is no income associated with that. So it's a way of shifting income out of your practice tax-free to individual, as long as you don't do more than 14 days in a year. And as long as there is a legitimate purpose. It could be a holiday party, it could be a company gathering, a board meeting, anything like that. So, let's say an event space for an all day is around $2,000. If you did that 10 days for the year, or even 12, if you did once a month meetings with your staff, that has the ability to give you $20,000 of tax-free income in your practice that does not flow through to your tax return. So highly recommended. It's something to definitely be able to take advantage of. It's fairly simple, and if you're not doing it, if you have meetings at your house and you're not taking advantage of it, then you're just leaving money on the table. QBI, so qualified business income. I don't know if I'm not sure if everybody understands it, but two, the question is, are you currently benefiting from QBI as the deduction? And I'll explain about what it is more. I want to be able to see if anybody knows or uses it prior to getting into the details. Not sure. Absolutely. All right. Well, so no. Okay. That tells me what I need to know. So let's talk a little bit. Yes, fully. Perfect. I love that. And so a little bit of a mixed bag here, but we want to make sure that we understand that. Now, for those that are currently using it, do you know where your income falls relative to thresholds? So are you below the threshold, within the phase-out limits, above it, or just not sure? So let's talk a little bit about what qualified business income is. It is a straight 20% deduction for your S corp, your partnership, those things that pass through as income to you in your practice. It is not eligible for W-2 wages or C corps, and there are some certain limitations based off of income thresholds that we'll talk about in just a second. But basically, if you have a business and that business made $150,000, then you're eligible off the top to take a 20% deduction or $30,000 deduction for QBI. So, a decent savings of $10,000 to $12,000 just off of that deduction. Now, it's sometimes often missed because it's not automatically applied, and it does require some filing strategies with your tax professional. It's also misunderstood in terms of just kind of the eligibility, but we'll walk through that in just a second. And it does take some proactive planning in terms of how you structure your business to be able to make sure that you qualify. And so, busy slide, but at the end of the day, there's two different types of classification. And unfortunately, healthcare workers and CPAs and accountants fall into the specified service trade or business category, which there are some limitations that because our businesses are based on our skill, our expertise, and our reputation, the IRS does limit the amount of QBI in those circumstances. But there are some ways around that. And for limitations for single filers and married, you're talking $200,000 to $400,000. Once you're above that, you start to phase out, up to $550,000 for a married individual. Once you go above that, you're no longer eligible for QBI. So, that again goes from 100% phases out to 550 by the end of the year. It is important to understand the healthcare worker side of things and the fact that they're specified service or trade. But we'll get into the next slide, some things to think about to maybe move some income outside of those. So again, once you're over those thresholds, there is no QBI deduction. So how do you plan and how you potentially be able to get the QBI deduction if you're outside or above the threshold? So it's based off of your individual income, not the business. So if your business makes $150,000, you make $400,000 in W-2 income or different sources, then all of that combined is what is used to figure out and calculate whether or not you qualify. But there are ways to decrease your income, particularly in a given year. You can look at your retirement contributions, your healthcare savings accounts, the bonus depreciation that we talked about. So vehicle purchases, short-term rental, equipment purchase that can bring down your overall income in the year, that if you know that you're going to be close to a threshold, well, that may help you in a timing decision to be able to not just be able to take the depreciation and bonus depreciation from the asset, but if it brings you within a limit that allows you to now take the QBI deduction, that's a compounding effect. So you get one deduction and now you get two for that same expense. So let's talk about without planning versus with planning. So let's say you're coming in and your total income is going to be $550,000, and now there's no QBI deduction. So but you are also at the same time interested in purchasing a vehicle that can be used in your trade or business. So let's say you buy a Range Rover, which is a over 6,000 pound piece of machinery, which allows you to be able to move away from some of the limitations. And that, let's say you're going to use that 75% in your business. Well, that $200,000 Range Rover is now going to create a $150,000 deduction in that current year, and your total taxable income goes from $550,000 to $400,000. You just went from no QBI to full QBI, which is now at your $400,000 income level, a potential $80,000 additional deduction, or a $25,000 to $35,000 tax savings. So that's where timing and planning and understanding where you are, not just from your business, but from your overall tax planning to be able to take advantage of as many things as possible. Going to very quickly go over this. I'm not going to go into great detail, but the IRS has released its latest findings. I actually wish I had done a poll on this, where in 2024, the audit environment, there was 500,000 audits done by the IRS. Now, you ask yourself, who do you think is at the highest risk of audit with the IRS? Surprisingly, it's people who make less than $25,000, because those are quite often the highest percentage of people who are underreporting their income. So half of the audits in 2024 were for income or people who turned in less than $25,000 or underreported income. Then it's more of the over $500,000 with complex returns that have Schedule C or self-employed. So Schedule C, self-employed, high earners, and low earners are your high risk. Your relatively low risk are your S corps, your partnerships, and your corporations. So these slides will be sent out so you can look at all of the others. The only other thing I would say is to minimize your risk is report your income accurately and keep documentation. If you do that, you'll be fine, and work with a qualified tax representative. Now we want to switch gears a little bit. We're going to move into our capacity strategy. And so how do you work with the most limited resource we have? And that's time. You can't get it back once it's spent. And so how do we use it as effectively and efficiently as possible? So we're going to 3 questions. We're going to talk about Invisalign. Roughly how active are you with Invisalign today? Is it less than 10%, 10 to 25, 25 to 50, or heavy with 50%? Now, next poll question is your schedule. How often is your schedule full? Are you at capacity? And then last question, growth. How are you growing today? Is it by adding staff, adding chairs, increasing fees, or you're not sure? As we've already talked about, time is our most limited resource. And so, for us to be able to grow, it's typically limited by our capacity or our resources. And so chair availability, staff time, and doctor time are going to play the largest role in our ability to be able to grow. And so today we want to talk a little bit about just the case study in terms of comparison of Invisalign versus braces. And I'm going to assume the treatment fees are the same, but the costs are different, but they're different in different ways. And we'll get into all of that. But their biggest component is probably the time that it takes, and from an investment and doctor time and staff time to be able to deliver the similar results. And then how do you do production with less time and get more production out of it? So this is a kind of the full picture of Invisalign versus braces in an ortho practice, and then we'll also go through GP. So, again, averages. I will say that the average lab fee for an Invisalign case is around $1,500. And materials, brackets, wires, we'll call that $650. I'm sure that those numbers can vary widely between practices, but there's definitely a cost difference between on the material side for braces versus Invisalign, and it is definitely slightly higher. Now, the real impact, though, is on time. And so with an initial consult and removal, you're talking, maybe an hour or slightly above an hour for the doctor time. And then, we're looking at a couple of hours on staff because they are coming in every, 3 to 4 months for a follow-up. Where on braces, you've got the bonding, the debonding, a lot of physician intensive time. And so, it's about 4.5 hours for braces compared to 1, like maybe-ish for Invisalign. And then they're coming in every 6 to 8 weeks. So for 24 months. And so each visit's anywhere from 45 minutes to an hour. So you can see, there's a huge impact of time, but there's definitely an impact on cost. What does that look like in total when you put it all together? So if you assume the same revenue, the cost difference, 15 to 650. If you take the doctor's time at an hourly rate of 150 and the staff cost at 26, you can see, it's 4.5 times, more costly for braces on the time. And then if you take total cost, the actual difference overall is fairly negligible. It's from a per profit per case standpoint, but it does allow you to do more patients in the same amount of time. And so with that, when you take the time difference of 3.5 doctor's hours and 12 staff hours, that's on one case. You do 10 cases, that's almost a full week of doctor's time, and a couple of staff members of savings. So what do you do with that? And then you can use that time and availability to be able to open up for more cases if you're already at capacity. If you're not at capacity, what I would say is, and I've said this for many years, I would suggest you get full before you get picky. And so if you have patients that want Invisalign or they want braces, I would open myself up to being able to try and get as many cases started as possible, and don't limit yourself by just the lab cost or the bracket cost. Once you're full, and then it's a capacity conversation. So wanted to do the case example of a $2.4 billion orthodontic practice. So we're saying that's about 400 cases a year at $6,000 per case of production. If you shifted 10 and you were at capacity and you shifted 10% or 40 cases from traditional braces to Invisalign, what does that create for you in terms of capacity? Well, it frees up about 147 hours of doctor time and then 500 hours of staff time. And so if you looked at the mix of what that capacity allows you to be able to do, that would allow you 140 more Invisalign cases or 30 more braces cases. And so from a production standpoint, you're at $6,000 a case. You're talking an additional $840,000 off of existing staff, existing time, existing chairs. And again, if from a braces standpoint, it's still $186,000 of additional production. So for, again, shifting volume, creating time, creating capacity to be able to take on more patients. The last thing on the Invisalign to really focus on from an ortho standpoint is, phase 1, phase 2 patients. I'm not going to dig too deep into this because I think we're probably going to run out of time. But what we always recommend at Global Practice Solutions is if you feel that there is a high probability that someone's going to go from phase 1 to phase 2, then the 5-year comprehensive makes the most sense, because with that, you complete phase 1. Now, as long as phase 2 starts within 5 years, there's not a second lab fee. So one lab fee pays for 2 phases of care, obviously increases your profit and a compounding return on investment. So for GP, so it's not a braces versus Invisalign question, but it is about a choice on production per hour. And so we look at same resources of chair, doctor, and staff. It's what's the production per hour, what's the time required for the doctor, how many visits are there, and then what's the overall contribution margin. So typical crown, $1,200 to $1,500. It takes about an hour and a half, 2 hours of doctor time. There's usually a couple of visits. So on a per hour basis, you're in that $700 to $1,000 range, or a blended $850. You can go with an Invisalign case. It's minimal physician time. It's usually handled mostly with the staff on the follow-up visits, and you're talking $4,500 to $6,000 of production there. So when you look at it just from a straight time and resources and production per hour, Invisalign is a definite advantage to add in because it can run alongside your core production. It doesn't require additional chairs. There's not longer appointment times. It actually leverages your hygiene visits. And so kind of the workflow goes in, they come in for hygiene, they get scanned, and then you can do the planning with the ClinCheck software right there. It takes about 15 to 20 minutes, and it really does not disrupt your restorative high value work. So just a comparison, I think it takes about 8 crowns to equal 2 Invisalign cases in terms of the overall production, but it's a far less fraction of the amount of time that it takes. So it's a nice add-in from a practice standpoint for your GP. It also helps you build your relationship with other orthodontists in the area, because you want to look at the level and time of the case. So typically in a GP practice, you would want to do your shorter cases, the cases that are anywhere from 9 to 12, maybe 18 months. And then the more complicated cases, you're now scanning those patients, and you can work with your local orthodontic partner to be able to refer those patients over to them. So I was told to finish at 12:46 to be able to end. Actually, I was told 12:45, so I'm 1 minute late. I apologize for that. But so the key is you don't necessarily always need more resources. You just need to be able to create more capacity, and you can do that by planning. So with that, we want to open this up to questions.
Thank you so much for the really in-depth presentation, and I hope everybody learned a lot from Jonathan Hoy. So we're going to move to questions, but quick reminder to scan the QR code or click the link in the chat when the session is over to make sure that you get your CE credit. And we will also be sending out the attendance verification form alongside the recording of today's session. So make sure you take care of that. Okay, a few questions. First up, we have one about tax strategy. The question is, if I already have a CPA, shouldn't they be handling all of this for me?
Yes and no. So it's going to be about your relationship with your CPA. If you're turning over all of your documents to your CPA and they're filing your taxes, then they're not really partnering with you. And there are a lot of questions that you need to ask your financial advisor to make sure they understand your goals and objectives, because when tax season rolls around, they're extremely busy and they're trying to get taxes and returns filed on time. If you're waiting until you're giving them your documentation for last year, you've completely missed the boat on the ability to be able to have any impact in changing your facts so that you can change your tax. And so that actually leads me to something that's also in the presentation that I'll quickly just point out. We do have an appendix in the presentation today, and I'm going to click through that really quickly because it goes to the question that you just asked. This is 21 different categories that all have 4 questions, if you're interested in a career, that you should be asking your CPA, from income projection to timing strategies to quarterly planning, cash flow, QBI, structure, all the way down to, at the very end, what questions do you need to be thinking about your CPA relationship? Is planning proactive or reactive? Are they saying, oh, well, you should have done this, versus, hey, can we think about what you're currently doing? What are you planning on doing? And how do we structure that in a way that minimizes your tax liability? So yes, they should be handling it for you, but only if you have a relationship where you're working together to be able to minimize your overall tax.
All right, next up, we have a question about equipment. And the question is it ever worth buying equipment just for the tax deduction?
I would say no. I mean, it depends on your facts and circumstances, but the first and foremost thing that you need to think about in any equipment purchase, or really any investment in anything related to your business, is, does it make sense? Do I need it? Is there a return on investment? And am I actually going to be able to use this asset in my business to be able to improve my bottom line? So I would not make major decisions based off of taxes alone. I would make decisions on the timing of when you make those purchases based off of how they will have the most tax benefit possible. So no to, don't just buy something because it's a tax deduction, because a $200,000 vehicle that gives you a $30,000 reduction in taxes is still a $200,000 vehicle. So you can keep your money and maybe pay taxes rather than having something that you don't necessarily use or need.
Okay, next up, we have one about QBI. And the question is, how do I actually know if I'm missing out on QBI?
So again, that one is one where you need to have a detailed conversation with your tax attorney. You absolutely should be reviewing your filings every year. I would start off with, again, having your conversation with your CPA and say, hey, can you walk me through what my QBI deduction was last year? Did I qualify? Did I miss out on a threshold? Let them talk about what has already happened so that you can take the past experience and past knowledge and be able to learn from that so that you can plan for the future and then work on a plan together.
And then lastly is, if profit per case is similar, why wouldn't every practice just switch to Invisalign?
Well, the market's going to dictate that by far, because braces still make up 70% of the market, and there may be, and I know Jason would say that there's very few things that can't be done with Invisalign, and he's very creative with that. But there's still a market for people who want traditional braces, just like there's a market for Invisalign. And so you don't want to limit yourself to any one product. So maximizing your ability to be able to grow based off of market demand, but at the same time, allow yourself to be able to use the modalities of care, being clear aligner versus braces, to get the best possible outcome for the patient. And so I want to make sure, from a finance standpoint, been a healthcare finance executive for many years, and I want to make sure I'm very clear on this. I'm not recommending that anybody makes a clinical decision based off of the financial results of, what they're doing. It's important that we do what's best for the patient and keep the patient at the center of everything we do. Now, that doesn't mean we shouldn't be in the business of dentistry and orthodontics and make sure we make the right decision. If we have two choices that give the same clinical outcome, then now that's where we can look at what makes the most business sense for our practice.
Wonderful. That feels like a great place to end today's session. The sign out link is being placed in the chat if it isn't there already. So reminder to go ahead and click that link or scan the QR code to make sure you get that CE credit. A recording of today's session and the slides will be shared just as soon as they're available. And if you would like to learn more about Gladwell Practice Solutions and access our team and engage with our many other educational resources, please visit gladwellpracticesolutions.com. You can find the best way to get in touch with Jonathan, with myself, with anyone else on Team GPS. And we hope to see you at the next webinar. Thanks for spending your lunch hour with us. Have a great day.
And before we sign off, I would like to thank, there's a lot that goes into the production around these. And so we have a very great quality, fantastic staff here at Gladwell Practice Solutions. And so just want to thank everybody for putting this together and making this so easy. And hope everyone enjoyed the session.